Hey guys, welcome to another Trade Genius podcast. This is Bob and Phil. As always, guys, important data came in today. It's not looking good, but we got to talk about it and spell out how this is probably going to go for you and your portfolio. So let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
Okay, Bob. So, I think obviously we've been warning for a pretty long time now that despite what the stock market might be doing, it's going to probably get more dicey as we progress through this year. Tell us about this latest data that came out.
Yeah, I think, Phil, this is a long series of economic data instruments that are showing high correlations to future activity and future profitability and also future stock market action that is running counter to the price action in the stock market over the last 10 weeks. And look, no matter what you do, you can only play with derivative games so long, but cash is king and companies require growing cash in order to grow stock prices over time. You can only cut yourself the profitability for so long before you start cutting the muscle out and just making your company impaired. So I want to show you this chart. And what's interesting too, Phil, is that I think the whole stock market has been predicated upon them being able to provide low cost of capital while the federal government provides ample liquidity in terms of largesse. They want basically their cake and they want to eat it too. But the bond market hasn't been cooperating since the beginning of the year. If you look at TLT, it's been on a sell since the start of the year. And that's the tell, and it's also an unwind of, I think, what they did, November and December. The stock market's going to follow that action because the correlations have been there. And then today, Davos is out there throwing all kinds of wet blankets on lowering interest rates sooner, even though they know this chart came out. And you have the Fed survey up from the Empire State. This was an atrocious business forecasting of future orders. Okay, this is awful. And this is the second one in a row. If you combine the two, it's actually an unprecedented collapse in future factory orders. And why this is important and why you should care is look at the correlation over a long period of time between the price of the S&P 500 and these orders. And you and I know why these alligator jaws keep happening is because they're pumping everything they can into derivatives into the top 7 stocks that happen to all be out in San Francisco. But this is the real world here. And eventually the correlation is going to catch up. And this is basically saying you can't have rising operating profits if you have lowering new orders coming in. And look, I was an executive. You ran a business too, is that you can only cut so much to generate margin before you start sacrificing revenue. And in the case of a public company, if you start sacrificing revenue, you can't cut. You reach a point where you hit your fixed cost area and then you're screwed. And I think we're at that point now where companies have taken the easy layoffs out of the picture, which we're going to see a lot of confessionals, I think, over the next couple of weeks about right-sizing companies. Citigroup just reported. I guess it was a disaster. That's the other thing too, Phil, is that Citigroup is kind of a bell cow for economic prosperity and calamity. They led the disaster in 2008 in terms of bank profitability, and it was awful this time. So I know you like to look at another indicator. We could just verbally talk about that before you think the whole thing's going to roll over. Just so people know where my head is, I said Martin Luther King we're not going to see another movement higher until we get out of March. And we already talked to you guys about the reasons why. Positive Grinch, negative first 5 days, first year, 4-year cycle of an election, that's of a first year president, the derivative flows for the options going into February. But the one that I think everybody's going to react to is the one that you're going to talk to us about right now, Phil. I'd like to get your thoughts on it.
Yeah, to me, Bob, it comes down to really jobs. And I think when you start to see that jobs data, because right now, NFP, and we can argue all day long about how real the numbers are. Sooner or later, real or not, those numbers are going to have to reflect some semblance of reality. Otherwise, then why even have numbers? Because it would be very obvious to everyone that it's just a joke. So I think at some point you are going to see numbers come down. And when they start going negative, when you start getting NFP reports that are negative, now right now, I think the last one was we added like 200,000 some odd jobs. So as long as you have this expansion, as long as there's positive job growth, I think you can essentially lean on this being somewhat bullish. I mean, there's going to be ebbs and flows, obviously, but you can lean on that. Now, once that starts to go away, we start seeing job numbers get under that 100,000 mark. You start getting down to only like 50,000 or 25,000. I think this market's going to freak out a little bit. And then we're going to start probably seeing negative job NFP numbers as the recession starts to take hold. So for me, Bob, I agree with you. I think you have a risk of going down into March. That is only if the bears can get it done because of this derivative world that we live in. If they don't get it done within a certain amount of time, then the hedging that goes on doesn't snowball enough to make it go down more. It's total leverage derivative game that we live in. So they do have an opportunity after this OPEX here coming Friday to push down. We'll see what they can do over the next couple of weeks. If they don't, I think the downside is mitigated. The weird thing is that we might even see a little bit of a blow off actually to the upside if they can't get it done, because we're really close to an all-time high here on the SPX. If they blow past that and it isn't like a double top type of thing, which is similar to what we got into 2008 market. We got a double top into a steepening yield curve. So there's a couple of things that we need to keep an eye on, is that yield curve going positive on the 2-year, 10-year yield curve, and then also whether or not we're seeing a double top of sorts or potentially one final push. Because one thing about these markets, and this goes back to even the 30s, is that before you get into some severe recessionary stuff, a lot of times the markets get really irrational and you will see basically a giant short squeeze in the markets that utterly collapse. And that scenario isn't great either, because unless you time the top perfectly, which I think if we do see that, that's going to give you an ample opportunity to exit the market, because I think it's going to be actually worse on the downside if we do something like that, because I think the fall will be just as fast back down, and it's going to probably unwind a lot of things. And I think the deleveraging isn't going to be fun in this market. So yeah, I think really jobs is going to be key here. I think the 2-year yield dropping as fast as it is also a warning signal. Now, initially, when that happens, as you head into a recession, that's actually bullish, and that's why I'm giving the bulls a little bit of leeway here. But then it starts to turn into a deflationary bust because it does not stop, and then you get the bear steepening of the yield curve, and that's why that symptom of the yield curve going back to positive and then heading up toward that normal 2.3% yield curve on the 210 is where I think the bear market will end up stalling out to the downside when we reach those levels. And again, this is going over many, many, many weeks. If you look at the bottom of the yield curve, we told you guys it's somewhere between 100 and 110 weeks from that. And that goes back to, I believe, May it was the yield curve bottomed. So that takes you all the way out to Q4 of 2025, like October-ish, which, I mean, that's like eternity away right now, especially if you're talking about a market that's not going to find its bull legs until then. So on one side, you have great opportunity because you can exit stage left, cap a lot of profits here, potentially go short the market and make more money on the downside. But then again, coming out of this, I think if we do get that scenario and we're down into 25, I think the opportunity for wealth generation in your portfolios will be probably the best we've ever seen in a long, long time in this market.
Yeah, and just to be clear with everybody is that, unless we break the October lows, we're just in an expanding range.
Yeah.
And so we're just trading what we see. We're just telling you from a macro standpoint, is the smart time to raise cash. I'm finding nothing really to buy. So I'm just raising cash. The shippers have been a good run. We're going to talk about those tomorrow, but things are getting real. And so, the upside 480 to 508 on SPY, I trade SPY, Phil trades ES, XPX, on the upside and downside, we can get down to 430. So it could be a pretty big range, but I think Phil and I are both in agreement that I think the disaster is going to come when the politicians likely want it to come, and that's going to be the end of summer this year. But my only caveat to that is if we make a lower low than the October low before Easter, then I think there's going to be some panic in the air, Phil. And and that's kind of where we are. And this today, market down, bonds down, oil down, classic people bailing out. And what I mean by bonds down, yields up. Not a good scenario. There's very few places to hide in that environment.
Yeah, I totally agree. Guys, let us know what you think and post your thoughts below on today's video. As always, thanks for watching. Please hit like and subscribe. Also, check out our stuff over at tradegenius.co. We got a number of different tools and things that can help you navigate these markets, and we'd love to see you in the rooms with us. Thanks, Bob. We'll see you guys on the next video. Take care.
Trade Genius.